One trade can change everything.
Hello everybody, welcome to today's trading tutorial. We're going to be reviewing swing failure patterns, and I think a lot of you will find this really useful because it can help you with I get a lot of questions about, hey, is this confirmed yet? How do I know if this is confirmed resistance or support? And swing failure patterns can really help you do that, right? So we'll go ahead and we'll take a look at it in range trading as well as using it to identify trend reversals. So let's say we go ahead and we have our range here, prices, bouncing between our high and our low here. And so what you have to keep in mind is that people who shorted in here and on the way down, it's likely that their stop loss is above the range high, right? So you would say, well, I think we're going to get a swing failure of the range high, right? So what would then happen? You'd get a move up, a wick above, and a closure below the level, right? So what just happened? People who shorted here and on the way down, having their stops here, likely got stopped out. Also, you have people who longed into this wick attempting to trade a breakout to the upside. However, this was confirmed as resistance yet again, right? It was resistance here, now confirmed resistance yet again because price in this candle closed below the level, right? We wicked above, but price closed below. So in that case, right when you get the candle closure, you would go ahead and enter your short position. You would put your stop loss above the high of the wick, right? And because this is a channel, you would trade it to the mid-range and then back down to the bottom of the range, right? It's as simple as that. You're not trying to enter a short on the wick. You're waiting for the confirmation, which is the candle closure, right? If we wick above, people are longing into the wick, trying to get a breakout. People got stopped out here, but then price comes back down and it closes below. That means that resistance that was confirmed here, resistance here, it is still resistance, right? Because the candle closed below. Now, similarly, price could then move back down to the bottom of the range, and you could say, I'm going to trade a swing failure of the range low. You would look for a wick below and for the candle to close back inside the range, right? Thus confirming support. It was support here, it was support here, and it is still support here, even though it wicked below, right? Because of the candle closure. So what happened? People who are longing here and on the way up likely had their stops here. They were likely stopped out. And also you have people trying to short a breakdown in here that are now trapped, thus giving us some fuel for a move back to the upside. And what would that look like? Is you would enter on the candle closure, you would have your stop loss below the wick, and because it's a channel, you would trade it to the midline. And then again, back to the top of the range, right? Now, in the event, I'm going to go ahead and delete all this here. In the event, let's say, of we have a trending market, right? Putting in a higher high, higher low, and price finally reaches resistance and rejects, right? Now what you would do is you would take your horizontal ray and you would mark this out and you would say, I think that we could have a potential swing failure pattern here, right? And what you would look for then is for price to come back up, reach the level, wick above, close below, and close below, right? And again, just like before, what happened? People who shorted in here are likely stopped out. And then you have trapped longs from people who are attempting to trade the breakout for continuation to the upside. This was confirmed as resistance, again, because we wicked above, but we closed back down below. So again, what would this look like? You would go ahead and you would enter your short on the candle closure, and you would look to trade it. You would then use technical analysis and determine at which point you would want to trade this down to. And you would look for then market structure change where you would start to take out some of these previous higher lows, right? Okay, so with that said, we can go ahead and take a look at some real world examples. I do have some of these that we actually traded live. It was really, really good back in this range here. I had a previous week high and low that were marked just like this. And basically, after they were marked out, we're trading in here, and I said, look, I'm going to look to trade a swing failure or a sweep of this low, and I'm going to look to trade a swing failure or a sweep of this high. And as you can see, we did get that wick below and a closure above. Now this one, I don't typically like it. For a swing failure, I would typically like to see the wick go a little bit further and then to close like kind of right above it, or a little bit closer. When you get a wick that's really deep like this, that stretches to grab that low and then closes up here, you can still go ahead and enter. I mean, as you can see, if you entered on that position there, right? If you would have went ahead and entered there, you had a place for your stop loss, you went ahead and entered, and you could have, you would have traded this really nicely back to the top of the range, taking profit at the midline again, right? However, what you can do as an added bonus with swing failure patterns, you'll often see this, is a back test of the 618, right? So if you go ahead and draw out your 618 Fibonacci, oftentimes when you get these sweeps or these swing failure patterns, you'll see price come down, back test, which can offer you a place to either have your entry, right? Because sometimes these swing failures can be an aggressive entry. So if you want a more of a conservative entry, you could, wait for the back test of the 618, or otherwise, if you did enter on the swing failure pattern itself, the entry there, you can use this as an opportunity to compound. So similarly, the range high, we can see if we actually go to a 2-hour time frame, we can see that this was a really nice swing failure pattern. Again, in this event here, we took out these highs, this high, and this high, right? So this was a really, really nice one coming back down here and closing much lower. That said, again, these wicks that stretch above, what did we say is it's really nice to look for some degree of a 618 back test in this event, right? Because on a 1-hour time frame, it actually did close above the level. It wasn't a swing failure pattern. So it's a little bit more of a deviation in that case, but on a higher time frame, it was a swing failure pattern. So if we go ahead and draw our 618, again, you can see we went ahead and back tested the 618 here before then having continuation to the downside. So choosing how you decide to enter in that case, is totally up to you. But nonetheless, on the candle closure, trading it then to the mid-range and then back down to the bottom of the range, or using the 618 as your conservative entry or a compound, right? So typically how I would do this is I'll use a lower time frame to sort of snipe an entry, let's say like a 30-minute time frame. I'll use to help me identify some of these levels, and then I'll sort of keep checking on higher time frames afterwards and so on and so forth to be sure it held, right? So you can look here and see like it was a, swing failure on a 1 hour, and then I'll go to a 2 hour and be sure, is it still a swing failure? 3 hour, are we still holding the level? 4 hour, are we still holding the level? And those things can really help you, continue to confirm that it is holding a support or resistance. But, starting on a lower time frame can really help you just kind of snipe the entry, right? And then as price action develops, right? Okay, so we'll go ahead and take a look at a little bit more of a traditional swing failure pattern. This one happened pretty recently, and I called this out in the Discord as well. This one is really, really nice. So basically, we're getting this move down, and we started to kind of round out a bottom. And I remember saying like, I don't really like this as our low here. We took it out a couple times, but I'd like to see some degree of a sweep of these lows, right? So if we go ahead and mark out our level here, you can see that this played out really, really nicely. We sort of rounded price out, got to move up. And this is the thing for me, when I see price round out like this, buyers weren't really showing up here, right? Like, this isn't a really strong move up. If we go ahead and pull up volume, we can see it was a move up on decreasing volume. It wasn't like very significant. What you would then want to look for, right, is a potential swing failure pattern. So we go ahead and we mark it out. We got the move down, a closure, a wick below, a closure above. We would have went ahead and entered right away at the candle closure, put our stop loss below the low, and then we would have used technical analysis to determine, where you would have wanted to take profit from there, right? As an added bonus to show that the swing failure went really well, is that the following candle was a bullish engulfing candle, right? This is a signal that buyers have shown up. and a signal of a trend reversal where you may see price, start to move in the opposite direction. That's really something that you would want to see. If you were to see, a sweep, but then price sort of continued to dangle around here and maybe go back down like this, that's not really a sign of strength. That's not something that you're really going to want to look for. You would want to see, that closure and then maybe like a bullish engulfing, or at least some degree of buyers starting to show up, increase in volume, etc., right? So let's go ahead and zoom out. I just want to like take a moment to talk about, marking these out on your charts. And this works out really well because we're nearing a place that I think would have a really nice swing failure. So what you want to do is you would look at the price action and you have to put your trading cap on and ask yourself, where are people's stop losses? Okay. So anybody that was longing in here, right, in this zone, it's likely that their stop loss is here. People who shorted in this zone, it's likely their stop loss is here. If they shorted here, likely their stop loss is here. If they shorted in here, likely their stop loss is here, right? People who are longing anywhere like previously in this zone, it's likely their stop loss is here. People that longed in here, it's likely their stop loss is here. And perhaps they adjusted and slowly moved it up or slowly moved it down over time, right? Entirely possible. So what you would then do is you would go ahead and you would take your horizontal ray and put your magnet tool on, and we would go ahead and mark these out. So here we have a potential swing failure pattern, right? We would have one here, and we have a bunch of equal highs that are pretty low. So in the event that we got that sweep, I would look, to hit them all. We have one here, here, and here, right? So you get the idea. And again, the goal is to say to ourselves, where are people's stop losses? Okay, so if people are, let's say they're longing, trying to knife catch, and they're just longing, dollar cost averaging on the way down, thinking that we're going to make new highs, whatever it might be. These people who are longing on the way down, where do you think their stop losses are? Well, they're likely below this low, or maybe below this one here, or maybe below this one here, maybe even below here, right? And so market is attracted to liquidity, right? It's attracted to liquidity. So when we're getting this move down, it's targeting some liquidity. It wants to hit a pocket of stop hunts, or hit a pocket of stop losses, or hit a pocket of liquidity where there's a lot of liquidation prices. And once it does that, right, target achieved, goal achieved, price can then start to round out and maybe get a move to the upside and do the exact same thing. So what I can tell you for certain is we're seeing a lot of aggressive shorting going into this, right? There has not really been any sort of a relief. Price has virtually been going straight down here. And we could see that buyers haven't really started to show up yet. This is like a fine balance, but it's nothing too crazy. So when you see this, I'm thinking to myself, well, it's likely that the target has not yet been hit. Okay, so you can go ahead and you can look at these lows here and you can say to yourself, well, I think this would be a really nice first target. So what you would want to see is maybe price start to round out here and then wick below, taking out those lows, closing above, and then to have market structure change, maybe come back test the 618 of the move, and then we would have some degree of a move up, right? And what would that look like is you would go ahead and you would enter on the candle closure, you would put your stop loss below the low of that wick there, and then you would go ahead and create new targets. And if we just go down to like a 1 hour time frame, and this is really, really nice here, we can go ahead and we can look at all of these highs, and we'd ask ourselves, well, if you've been shorting here on all the way down, where do you think their stop losses are going to be? Well, it's pretty likely, in my opinion, that those stop losses are above this high, right? So we can say, well, I'm going to look for a swing failure of that high, right? So let's say we get our move, right? We get our move up, we have market structure change, we come back test the 618, then we have continuation to the upside. You can say, well, I'm going to look for a swing failure of this high. We get a wick above, a closure below, and then in this case, you look to trade it back down and maybe look to a new target a little bit lower, that maybe may be a primary target or a primary goal for the market, right? But anyway, you would enter on that closure. You would put your stop loss above the high of the wick there, and then you would go ahead and trade it to, using technical analysis to determine wherever your wherever your target may be, right? So we'll go ahead and leave it at that. If you guys have any questions, or if anything you found anything confusing about this, feel free to ask in the Discord. I'd be happy to do a follow-up video. But ultimately, the swing failure pattern is very useful in range trading. It's useful in determining places where you may see a trend reversal. It's really important to, like I said, put your trading cap on and ask yourself, where are people's stop losses, right? And you can use that to your advantage because, like I said, when you're getting a move down like this and it's so aggressive, right? People who are longing in here, where are likely their stop losses? Well, they're probably putting them below here. The market's not going to reverse until it sweeps those lows, takes those stops, right? And then we'll look to trade it back up. And where do we look to trade it to? Well, again, we go here and we say these are probably where people's stops are. That's probably where we're going to go up and we're going to take that high. So again, I hope you find this useful for, like I said, channels, trend reversals, and especially for confirmations. Using candle closures to determine if something holds as support or resistance is just such a key thing. So we'll go ahead and end it there. As always, guys, thank you for watching. And if you have any follow-up questions, feel free to ask in the Discord.